Hey, it was quite a week in the market this week. We had a lot of companies issue earnings. In my portfolio, 9 stocks, 25% of my holdings issued earnings last week. I want to go through quick takes on every one of those earnings calls. And then at the end, I'll give you an update on my portfolio, including the options portfolio. If you're interested in that, stay tuned. Hey guys, welcome back. Kevin Burgess here with yet another video. So last week was a big week in the market. We had a lot of earnings calls to go through. I'm excited to share with you the ones that I looked at last week, which I happen to hold shares in. So these are shares in my portfolio. I want to share all of this with you. I'm excited about that. I think it's going to be good if you own these shares to get this quick take update so that you can see what the earnings were if you happen to miss the call. Secondly, if they're on your watch list and you want to get an update on what they reported for the quarter. But lastly, if you're looking for new stock ideas, these stocks I actually hold in my portfolio, so it might be worthwhile for you to take a look at these. Obviously, you got to do your own due diligence. I am not a financial advisor, but I do enjoy this kind of thing, so I wanted to share all of this with you today. If you like this kind of video, don't forget to give me a thumbs up, and if you want to see my journey continue, please hit that subscribe button. I'd love to have you along for the journey. So with that, let's get started. Okay, let's get started on the quick takes from this past week's earnings releases for the stocks that are in my portfolio. So our first stock on the list is Johnson & Johnson. So on these slides that you will see where I'm doing the summary of the call, you'll notice in the upper right-hand corner is a circle, and that circle will either be green, yellow, or red. If it's a green circle, that means they had a great call, a great quarter, and so things are looking great for them. The yellow is, it's okay. They had an okay quarter. And then for anything that's red, had a really rough quarter. These colors do not mean how I feel about the stock. These colors represent how I believe their quarter turned out. So in Johnson & Johnson's case, it's a yellow, meaning it was just an okay quarter. Non-GAAP EPS of $2.55, which beat consensus estimates by 6 cents. And they had revenue of $23.8 billion, which beat by $360 million. So they beat on both the bottom line, which is EPS, and the top line, which is revenue. So if we just stopped there, it would have been a great quarter, but they lowered their fiscal year 22 guidance. And so revenue is now expected to be 93 to 93.5 billion. Previously, they were saying 93.3 to 94.3, and then their earnings are now at $10.02 to $10.07. So the midpoint of that is somewhere around 10.045 would be a midpoint. Their previous guidance was $10 to $10.10. So the midpoint there would be a 10.05. So they slightly lowered their guidance in terms of earnings for this year. And back in September, they announced a $5 billion share repurchase program. I didn't want to lose sight of that. So for the week, Johnson & Johnson was up 2.58%, and they declared their next dividend, which was no change. So overall, a pretty decent week for Johnson & Johnson. But again, they had a good quarter in terms of their performance, but by lowering the guidance, kind of made it an okay quarter and earnings release. Now let's move on to the next stock in the list. The second stock is Lockheed Martin. Now Lockheed Martin, as you'll see on this slide, I have a green circle on them. They had an incredible quarter, an incredible call. So some of the highlights are they reported EPS of $6.87, which beat the estimates by 15 cents. They had $16.58 billion in revenue, which missed by about $100 million. They reaffirmed their 22 guidance, and they increased their share repurchase authority by $14 billion. That's a lot of money. Also, they reported that they increased their backlog of revenues by $140 billion. And basically what that means is they have $140 billion more waiting to be built and manufactured and sold than they had this time last quarter. Now for the week, you can see why this is a green circle. They were up 16.74% on the week. And then back on September 30th of this year, about 3 weeks ago, they increased their quarterly dividend by 7%, up to $3 per share. So Lockheed Martin had a great quarter. They had a great week, and glad I have them in the dividend growth portfolio. Now, the next stock on the list, stock number 3, is IBM. IBM had a great quarter. You can see in the upper right, I have it listed as a green. They had non-GAAP EPS of $1.81, which they beat by 1 cent, what the consensus was. Their revenue beat by $550 million. In terms of guidance, they are increasing their revenue guidance for the year, but they've reaffirmed the other metrics. So just some key points, I think, which are interesting for IBM and something that we are looking for when we think about IBM and their future. Their software revenue is up 7%. It's up 14% at a constant currency basis. Their consulting revenue up 5%, which would be up 16% using constant currency. Now, when you look at software and consulting, what IBM says is those two things are their growth engine for the future. So with software and consulting revenues moving higher, they are delivering on the plan that they laid out about 9 months ago, maybe a year ago. Their infrastructure revenues are up 15% or 23% under constant currency. And their hybrid cloud revenue, which is another key component to their strategy, over the last 12 months is $22.2 billion, which is up 15% or 20% at constant currency. So for the week, IBM was up 8.21%. And probably most importantly, because their dividend is such a huge percentage of their free cash flow, their free cash flow is still predicted to be $10 billion by the end of the year. Now, for the next stock on our list, stock number 4, we turn to Kinder Morgan. Kinder Morgan, if you're not familiar with them, is a pipeline company. They had non-GAAP earnings of 25 cents, which missed by 4 cents per share. Revenue of $5.18 billion, which beat by $630 million. You can see I've kind of labeled them as a yellow for the quarter. It's kind of an okay quarter for them. So they missed in their earnings guidance, but they have increased guidance for the year. They're saying that their net income will be favorable to budget by 3%. And their adjusted EBITDA and DCF, which is distributable cash flow. Most of us think of DCF as discounted cash flows, but that's not the case here. DCF stands for distributable cash flows. That's the cash they can distribute to investors. They're expected to be favorable to that by 4 to 5%. So overall, kind of an okay quarter. They were down on the week by 1.92%. They declared their next dividend with no change. And next on the list, stock number 5 is AT&T. AT&T, as you can see, I believe had a great quarter. It's a green in the upper right-hand corner. Their non-GAAP earnings were 68 cents. They beat by 7 cents. Their revenue was $30 billion, which also beat the guidance by $140 million. They increased their guidance on the year. They increased their earnings to $2.50 per share, which is higher than their previous outlook of $2.42 to $2.46. So in the mid-range of that would be $2.44. So pretty nice increase in their earnings per share. And one other thing that came out of the call that I wanted to mention is that 96% of their debt is fixed versus floating. Now, in an environment of increasing interest rates, being able to have 96% of your debt fixed kind of puts you in a position to deliver on what you've committed to deliver to, because you don't have this drag on of interest expense on your earnings. So just a few things that came out of the call. They had 708,000 postpaid phone net adds. They had 338,000 AT&T fiber net adds, which is their second best quarter ever. 11 straight quarters with more than 200,000 net adds. They had wireless service revenues were up 5.6%, the best growth in more than a decade. They were up on the week by 14.08%. Their free cash flow payout ratio, which it was not in their materials, I had to calculate it, but I wanted to share this with you. I think this is a good metric to look at for AT&T. Their free cash flow payout ratio year to date, 97%, which is very, very high. But in the third quarter, guys, look at this. Third quarter, 52%. One other thing I will point out about AT&T is that they are teaming up with the military, and I pulled these things off of the web. Specifically, they're teaming up with Lockheed Martin to improve aircraft readiness. And I did a little bit of research on this. I don't know that it's a tremendous revenue improvement for AT&T, but I do like the approach. I like that they're looking for new ways to help in other industries than what they're being able to play in right now. So Lockheed Martin actually mentioned this on their earnings call. So before I talk too much more about that, I want to talk about our sixth stock on the list. And today that is going to be Verizon. Now, Verizon, I believe, had an okay quarter. You can see with the yellow circle in the top right corner of the slide. They had non-GAAP earnings per share of $1.32, which actually beat by 3 cents. Their revenue was $34.2 billion, which beat by $410 million. They reaffirmed their earnings per share of $5.10 to $5.25, as well as other metrics. They had a slight improvement in their debt. And similar to AT&T, I like to calculate this free cash flow payout ratio. You can see on a year-to-date basis, rather than in the 90% range for AT&T, their year-to-date is at 67%, but their third quarter is exactly the same as AT&T's at 52%. So both of these companies have improved their cash position, and their dividends in relation to cash is improving. However, Verizon for the week was down 2.83%. So the moral of the story between AT&T and Verizon is I'm beginning to see AT&T taking a much stronger strategic performance perspective. So because of that, as I move forward, any investment I make in the communications realm will be more toward AT&T rather than Verizon. I'm not going to sell my Verizon shares, but I will be investing more in AT&T as we move forward. Now, our number 7 stock on the list is Philip Morris. Now, Philip Morris, you can see in the upper right-hand corner, I think had an okay quarter. They had a non-GAAP earnings per share of $1.53. They beat by 17 cents. They had revenue of $8.03 billion, which also beat by $730 million. However, they lowered their guidance. Their targeted 2022 full year reported diluted earnings per share, that's a mouthful, of $5.47 to $5.62 is lower than their prior outlook, which was $5.73 to $5.88. And they have several different ways that they look at their earnings. I think they overly complicate things. They have this diluted earnings per share, an adjusted diluted earnings per share, a pro forma adjusted diluted earnings per share. The point is that in all of those, they're going down. So they're lowering their guidance in all 3 of those particular metrics. Some of the other key things is they came to an agreement with Altria Group to be able to market and sell IQOS, which is a brand of smokeless tobacco in the U.S. They paid them $2.7 billion. I think $1 billion of that has been paid, and about $1.7 billion will be paid by 2023 sometime. They also increased their bid for a company called Swedish Match, which is over in Sweden, obviously. And so they are really making strides in this whole area of smokeless tobacco from a worldwide perspective. So I think they're making the right decisions. I think they're being strategic in their approach. They had an okay quarter, even though they beat on the quarter, they lowered their guidance for the year. But they're making some pretty good decisions. They're up 1.47% on the week. So Philip Morris, for me, will continue to be a company that I'm investing in moving forward. Now, moving on to the number 8 stock for the week is Whirlpool. Now, Whirlpool, as you can see in the upper right-hand corner, had a really rough quarter. They had earnings per share of $4.49, which missed by 86 cents. They had revenue of $4.78 billion, which missed by $370 million. They've lowered their guidance. They're guiding cash flow now at $950 million, which is $300 million less than their previous guidance and $700 million less than 2021. Their revenues and margins continue to decline. However, they are seeking ways and have sought ways over the last several years of reducing fixed costs. And why that's important is that when the economy does turn around, they have less fixed costs and they're able to capture more of the increase as variable margin and therefore make more money in the end. So some of the key items from the call: they're pausing their share repurchases. They are divesting of their Russian operations that's supposed to close by the end of October. They are acquiring InSinkErator. Now, InSinkErator has a lot of like garbage disposals, or in your sink and things like that. So I think that's a great move for Whirlpool. They are also coming close to completing their strategic review of the Europe, Middle East, and Africa segment that they have. So looking forward to seeing what that delivers. And I believe because of these fixed costs that they're reducing, that when the economy does begin to recover, they're going to recover more quickly. And they were down 5.74% for the week. So rough week for Whirlpool, rough quarter for Whirlpool, but I still believe in them in the long term. Now, stock number 9. Stock number 9 for last week was Robert Half International. Robert Half, as you may know, is a consulting firm, mainly in the financial area, accounting, auditing, and those kinds of activities. They had earnings per share of $1.53, which missed by 11 cents. Their revenue of $1.83 billion missed by $80 million. They've lowered their guidance. And the interesting thing here is that Robert Half only guides for the following quarter. But JP Morgan estimates a $6.02 2022 versus what they previously thought would be $6.40. Now they're looking into 2023, and 2023 JP Morgan had guided around $6.50 for Robert Half. Now it's at $5.75. Some of the quotes from JP Morgan, which I thought were helpful: while temporary staffing firms like Robert Half may get quickly impacted during an economic downturn, they are able to respond quickly and typically enjoy tremendous tailwind on the upswing as well. That's JP Morgan. They also said that RHI's exposure to small and mid-sized clients appears more sensitive to the uncertain economic environment than the enterprise client base. And with rising recessionary risks, we think that the risk-reward balance on the RHI stock is skewed more to the downside. So they're saying that as the economy continues to falter, that it's going to be more focused on the smaller to mid-sized businesses, which is kind of where the sweet spot is for Robert Half. And so they're saying that, as the economy moves forward and continues to decline, as they're trying to get inflation under control, that Robert Half's client base are going to struggle a bit. And I don't disagree with that. So I do own a little bit of Robert Half. I really bought some shares to open a position. I own 50 shares. So I will likely not be adding more Robert Half in the near term, but it is something that I'm looking forward to adding to, as the economy maybe bottoms out and begins to recover. And they were down 9.86% for the week. Now let's move on to the portfolio update for the week ending October 21st. You can see that the portfolio went up about $32,781 for the week. So we had a pretty good week in the portfolio. We had dividends of $359, and we were able to capture some option income of $64.31. We put $50 into the dividend snowball account. And overall, you can see that the market change for the dividend income account was only 3%. And the dividend growth account was 4.6%, while this snowball account was 4.9%. So averaging all of those together, the portfolio increased by 4% versus the 4.7% by the S&P 500. So if we flip down here on a year-to-date basis, we can see that we're coming close to $23,000 in dividends this year. We'll reach that, I believe, if not in October, certainly in November. We've had about $739 so far in options income. The market value of the portfolio has declined by about $76,000, which equates to around 9.2% overall, versus the S&P 500, which is down 21.8%. So I'll take that any day. And then just to carry this out a little bit further with dividends received, which are these items over here, you can see that our total return is around 6% down. So we have lost about 6% on the year, which in this year is not a bad place to be. So I'm pretty happy about that. You may recall that I transferred a Roth IRA into my brokerage account so that I could trade options on it. So I had 3 options for the week. I sold puts on Texas Instruments, Cisco Systems, and Medtronics. So the put premium on all 3 of those was $200.93. So when I look at the return, it's 0.76. On an annualized basis, it's 39.4%. I'm not going to go in depth on the options portfolio every time, but I do want to let you know what the performance was for the week and what options that I had entered into. So we had a pretty big week on the market last week, and guess what? Next week, we have 8 more. So it's going to be a big week this week as well. Looking forward to that one also. If you like this kind of content, please give me a thumbs up and subscribe if you want to follow along. And with that, I'm going to get out of your hair, and I'll see you on the next video.